I think the shock of all shocks to those who do not believe in Bitcoin or think it's a Ponzi scheme or, are blockchain, not Bitcoin, in their focus. They're shocked that the Bitcoin has gone from 19,000 during the heat of the bank crisis in that second week of March to 29,000. It's a flight to safety. That's what this is. It's a flight to safety. And those who understand the value of Bitcoin as really the Bitcoin blockchain evolving a new global monetary system that is not hostage to any human decision makers, is decentralized, transparent, auditable. More and more people want that. And, this is proof of concept.
Bitcoin, recognized as a compelling safe haven asset, has gained prominence amid economic uncertainty, as acknowledged by Cathy Wood, the CEO of Ark Invest. Cathie, a long-standing advocate of Bitcoin and one of the first institutional investors in Bitcoin and Ethereum, consistently highlights its potential as a hedge against inflation, deflation, and wealth confiscation. She sets a base case target of $1 million for this digital asset, emphasizing its role in wealth preservation for both the affluent and the less privileged. Additionally, Bitcoin serves as an insurance policy against hyperinflation and excessive government control. In the latest Ark Invest update, Cathie argues that both Bitcoin and Ethereum have grown in value due to their decentralized nature, which shields them from inflationary pressures. Consequently, they provide a reliable store of value, capable of mitigating economic uncertainty and instability. Stay tuned until the end of the video, where Cathie delves into the latest economic indicators and challenges prevailing inflation predictions. She asserts that economists have misconceptions about inflation and anticipates a faster decline, which she believes will further drive adoption and increase the value of both Bitcoin and Ethereum.
Bitcoin came out of the ashes of 08-09, basically it was designed decentralized, transparent, auditable, as an antidote, a place, again, to go, a monetary system to which investors can flee. And that's exactly what's going on. This move from 19 to 29 was not a flash in the pan. We are still there. And if you look at our Bitcoin monthly, it just came out this week, a couple of days ago, you'll see that the signals, we measure the health of the Bitcoin blockchain in that piece. And you can see the health on a day-to-day basis, and it's very, very healthy. And then there's another market indicator. It's away from fixed income and digital assets. It's commodity prices. All of the prices I usually cite are down from their peaks, and all but gold and silver are down on a year-over-year basis. And we're watching gold very carefully. It, like Bitcoin, and to some extent silver as well, are flights to safety if people don't trust the banking system. But we also have to be mindful that gold is a very good inflation gauge. It peaked in August of 2020, and it's still in the range that has been in place since then. But we're paying close attention. Is it rising? Is the price rising because of a flight to safety? We would suggest so. But there's always that risk that gold is picking up on fears also that the Fed, those who don't believe the Fed should ease, and we're not in that category, but there are many people out there and who worry that the Fed will pivot, might be hedging that possibility with gold. Okay, I'm going to get to economics. Most economic statistics to us pre-March, meaning they perhaps were, the March numbers were reported in April. They may not mean too much now because of this banking crisis. So we're trying to pay more attention to what we know about April. And of course, today's the employment report. And we saw the unemployment rate drop to 3.4%. That ties recent history for a low. You have to go back to the 60s, 70s to see lower. And, that's why a lot of people, and I think Powell and many on the Fed included, think we risk a 70s style inflation. We don't agree with that at all. I've said many times the 70s inflation started in 1964, so it built over 15 years before Volcker tackled it. This inflation, we think, is supply shock driven from COVID and the Russia invasion of Ukraine. So we take issue with that. So the employment itself, non-farm employment, came out higher than expected, 253,000. Expectation was 185,000. But we're learning something very important from these reports. Downward revisions to previous months, which always happens at turning points. So last month, when I was giving this presentation, we thought that employment had increased in March by 236,000. It turns out, after this first revision, that the actual increase was only 165. Now think about how differently the markets would have responded if we got that number. And it may be revised down again. We get a lot of downward revisions at turning points. And in fact, we've gotten 149,000 jobs revised down just from this one report. So employment's a lagging indicator on top of all of this. So I don't know why we spend so much time on it, except that the Fed's spending time on it. And that's unfortunate. And the reason this time it might be even more of a lagging indicator than it is normally is because of the massive shortages that we've suffered through because of COVID. And therefore, the decision on the part of companies just to stick with workers, even if at the margin business is slowing down, because they don't want to, if they're wrong and business doesn't continue slowing down, they'll have to go out and, rehire people. And it's been so hard. Now we're getting other indicators from employment that it's fraying at the edges. Initial unemployment insurance claims. On April 1st, there was a huge revision. Again, the bank crisis had happened, and I think the government, those collecting data for the government, are adjusting to that. So while we thought claims were at 198,000 for the week ended April 1st, it turns out that they were more like 246,000. That's a 24% increase. As far as JOLTS, the job openings, we've seen a 20% drop in the number of job openings from roughly 12 million in March of 22, that's when the Fed started tightening, to 9.6. We're also seeing continued layoffs. I think the latest Challenger survey said that job layoffs in corporate America were up, I think it was in the 170% range on a year-over-year basis. Now, the Fed is also focused on another lagging indicator, average hourly earnings. That was another positive or upward surprise. It's negative for the Fed. They don't want that. So 0.5 versus 0.3 expected. So on a year-over-year basis, average hourly earnings are up 4.4%, not 4.2%. Here is where we come into another concept that is going to throw off statistics, and it is, are we measuring the economy correctly? We do not believe we are, and we believe that productivity is mismeasured, and we're going to be putting out a convergence report and getting into that later this year. So if productivity is up 2 to 4%, which we think it easily could be. Just think about what ChatGPT is doing. Just use your imagination. And then 4.2% average hourly earnings is not inflationary. So, and it gets us within our 2%, the Fed's 2% desired range. So how that works is wages up 4.4%. And if productivity is up, let's just say 3%, then you subtract productivity from that 4.4%, and you've got roughly 1.5% underlying inflation.
For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.